Thank you for tuning in to LeadDeveloper.com, where we simplify complex property development feasibilities, investment analysis, and everything real estate. Whether you're a seasoned pro or just starting out, our Google Sheets-based feasibility suite streamlines the toughest aspects of real estate. Lead Developer Feasibility Suite is trusted by thousands in over 17 countries. Our tools cover everything from quick assessments to detailed cash flow projections and more. Sign up today at LeadDeveloper.com for unlimited free access to our expanding library of real estate tools. No credit card needed. Plus, get full support through Edge with step-by-step guidance, exclusive courses, and resources designed for your success. Turn numbers into narratives that win over investors and lenders. Join Lead Developer now.
All right, so let's jump into property syndicates.
Okay.
They're kind of this fascinating mix of teamwork and real estate.
Yeah.
Where investors team up to do these projects that might be a bit much on their own.
Right.
We've got a whole bunch of research here.
Okay.
We're going to unpack how these syndicates work.
Right.
Look at the good, the bad, and just see if it's something you might want to consider for your real estate investing.
Yeah, sounds good.
What's been grabbing your attention with these property syndicates?
What I find really interesting is that they open up a whole new level of real estate investing.
Yeah.
You know, we're talking large-scale developments,
Yeah.
commercial properties,
Yeah.
stuff that might be a bit out of reach for most individual investors.
Okay, so we're talking pooling resources
Exactly.
to play in the big leagues.
Uh-huh.
But before we get too far ahead of ourselves,
Yeah.
let's break down the roles here.
Okay.
Our research keeps mentioning this difference between sponsors and investors.
Yeah, that's really the core of how these syndicates work.
Right.
So the sponsors, you can think of them as the experienced developers or property owners who have the project they want to get done.
Okay.
They have the expertise, but they might not have all the cash.
Got it.
That's where investors come in.
Yeah.
They provide the funding, and in exchange, they get ownership of the project.
So it's a strategic partnership.
Exactly.
Win-win, where both sides bring something valuable to the table.
Right.
Now, how does this compare to a REIT,
Okay.
a real estate investment trust?
Yeah, that's a great comparison.
I know some folks might be more familiar with that.
So with a REIT, you're buying shares in a company that owns and manages a bunch of properties.
Got it.
So it's more hands-off.
Okay.
You're sort of exposed to how well that whole portfolio does. Syndicates are different.
Okay.
They give you more direct ownership.
Okay.
You're investing in one specific property.
Got it.
You often have a say in big decisions.
Right.
It gives you more control.
Okay, so a bit more hands-on. Less riding the market waves and more like steering your own ship.
That's a great way to put it.
Now, before we dig in,
Yeah.
there's this thing about public versus private syndicates.
Okay.
Is this like the VIP section of real estate investing?
It kind of is, yeah.
Okay.
Public syndicates, they're open to more investors.
Okay.
Anyone who meets the accredited investor rules.
Right.
And just so we're clear,
Yeah.
accredited investor usually means you need a certain income
Okay.
or net worth to show you can handle a bit more risk.
So public syndicates, it's a broader, more sophisticated crowd.
Right.
What about private syndicates?
They're for a smaller group,
Okay.
often hand-picked investors.
Got it.
It's like a close investment circle.
Mm-hmm.
And this can have some perks,
Okay.
like maybe better deals,
Yeah.
more control over the decisions.
Got it.
But it does come with some responsibility.
Okay.
You have to carefully check out the sponsor,
Right.
make sure the project aligns with your goals and how
Right.
much risk you're okay with.
Yeah, so I'm starting to see why this is appealing.
Yeah,
We're talking about potentially getting into bigger, more exclusive deals.
right.
But what are the other advantages of this property syndicate route?
Well, the big one is pooling resources.
Okay.
It lets investors get into projects they couldn't afford on their own.
Yeah.
Think about it.
Okay.
Could you buy a multi-million-dollar apartment complex by yourself?
Probably not.
Probably not. But if you join a syndicate,
Yeah.
you can get a piece of that action.
Got it.
Tap into a level of investing that you wouldn't be able to otherwise.
It's like crowdfunding for real estate,
Yeah, a good way to put it.
democratizing access to these bigger, more profitable opportunities. Now, I know real estate is all about location,
Right.
but diversification's key too, right?
Absolutely. And that's another benefit of syndicates.
Okay.
Instead of putting all your eggs in one basket,
Yeah.
you spread your investment across multiple properties through different syndicates.
Got it.
This helps if one property doesn't do well. You got others to balance it out.
Okay, so we're talking bigger deals, diversifying our portfolio.
Right.
And there was something in our research about professional management too, right?
Yeah, that's a huge perk.
Okay.
Most syndicates hire professional property managers.
Okay.
They handle everything.
Like what?
Tenant relations, rent collection,
Okay.
maintenance.
Got it.
Basically everything to keep the property running smoothly and making money.
So it frees up the investors
Exactly.
from having to be a landlord.
Right.
It's like having a team working to get the most out of your investment.
That's a great way to think about it.
Without you having to lift a finger.
Right.
Let's say someone is listening to this.
Okay.
And they're thinking, this sounds interesting.
Yeah.
How do I get started?
Well, the first step is finding a sponsor in a project you like.
Okay.
Networking is key here.
Got it.
Real estate events, connecting with industry professionals. You can even look at online platforms for syndication.
Okay, so it's about getting connected in the real estate world.
Exactly.
What happens next?
So let's say you find a sponsor and a project that looks promising. This is where due diligence comes in.
Right.
Before you put in any money, you want to look over those offering documents very carefully.
So it's like reading the fine print.
Exactly.
Making sure you know what you're getting into.
Right.
No one should be signing anything without a clear picture.
I agree completely.
And if everything looks good, aligns with your goals and risk tolerance, then you can make the investment.
Right.
Are there different ways to do that?
There are, yeah.
Okay.
You've got the traditional wire transfers and checks, but there are also online platforms that make it really easy.
Okay, so we've covered the basics of property syndication.
Right.
What it is, who's involved, the benefits, how to get started. But now let's get into some of the finer details. The important things investors should think about before taking the plunge.
Right.
Our research really emphasizes the legal side of these syndicates.
Yeah, it's important.
Why is that?
Well, the legal structure determines how the syndicate operates,
Okay.
how profits are shared, and how liability is handled.
Got it.
It's the whole foundation of the investment.
Right.
And our sources, they all say unit trusts are the best way to go for these.
Okay, so unit trusts are the gold standard for structuring these.
You could say that, yeah.
But what makes them so good?
Well, one big advantage is the protection they offer investors.
Okay.
A unit trust separates your personal assets from the syndicate's liabilities.
So if the syndicate runs into trouble,
Yeah,
my personal assets are protected.
for the most part, yes.
That's a relief for investors,
It is.
knowing they have that safety net.
Right.
Our research also talks about borrowing, using debt to finance these projects.
Yeah.
That can be risky, right?
It can be.
Right?
Borrowing can boost your returns, but it also increases the risk.
Right.
Our sources suggest being cautious,
Okay.
keeping the total borrowed money under 65% of the property's value.
So 65%, that's the magic number.
You could say that.
Why that number specifically?
Think of it as a stress test.
Okay.
If you keep borrowings below 65%,
Yeah.
the rent should cover the loan payments.
Got it.
Even if there are vacancies or unexpected costs,
Okay.
it's a safety net, so the syndicate isn't over-leveraged and gets into financial trouble.
So it's like building a cushion
Yeah, good analogy.
into the financial structure to protect it from the unexpected.
Exactly.
Now, what if an investor wants out of the syndicate?
Okay.
Like they need to get their money back.
Yeah, good question.
How does that work?
Well, there's not a public market for syndicate units like there is for stocks.
Right.
But the trust deed, which outlines the rules of the syndicate,
Yeah.
usually has rules for transferring ownership.
Okay. So it's not as simple as selling shares,
Right.
but there is a way to do it.
There is.
What are some other things to consider from our research?
Well, they talk a lot about periodic reviews.
Okay.
Usually syndicates will review how the property is doing every 4 years or so.
Got it.
This gives everyone a chance to decide.
Yeah.
Do we hold on to it? Do we try to sell?
Okay.
Or do we need to change our strategy?
It's like a checkup,
It is.
a chance to reassess and make sure things are on track.
Yeah, exactly.
Now, when it comes to picking properties for a syndicate,
Yeah,
are there certain things investors should be looking for?
absolutely. Not every property is a good fit for syndication.
Got it.
Our research has some guidelines to help investors find good properties.
Okay, so what's on this checklist?
Okay, well, first,
Yeah.
the property should be adaptable,
Okay.
suitable for different uses.
Got it.
For example,
Yeah.
a building that could be easily converted from offices to retail or even apartments, that would be ideal.
So it's flexible.
Yeah.
Ready for anything.
Exactly. It has to comply with all the legal and planning rules.
Right. You don't want any surprises down the road.
Exactly. And our research also mentions newer properties.
When you say newer,
Yeah.
are we talking just built in the last few years?
Not necessarily. It's more about the depreciation benefits.
Okay.
Newer properties usually have more generous depreciation allowances.
Which means?
Which means tax advantages for investors.
Ah, the tax advantages.
Right.
Always a bonus.
They are.
What other features should we be looking for?
Low maintenance is a big one.
Okay.
Properties that need constant repairs can eat into your profits.
Yeah, turning a potential cash cow into a money pit.
Exactly.
So we're looking for something durable,
right,
low maintenance,
yeah,
anything about the design.
Yeah, design matters.
Okay.
Our research says to look for timeless or adaptable designs.
Okay.
Properties that can change with the market.
Got it.
So for example,
yeah,
a building with open floor plans that can be reconfigured, or a property that can be divided into smaller units.
Okay, so it's all about future-proofing the investment.
Exactly.
Making sure it can adapt as the market changes.
Right.
And of course, we can't forget about location.
Right. Location is always key.
That's always a top consideration.
Our research agrees.
Okay.
They say focus on properties in good metropolitan areas.
Got it.
Ideally not too far from the central business district.
Right. So good access, good connections,
Okay.
being part of a busy economic hub.
Mm-hmm.
But just as there are properties that are perfect for this,
Yeah.
are there types that are a no-go?
Definitely.
Okay.
Our research specifically says to avoid speculative or specialized properties.
What do you mean by that?
They're properties that are for a very specific market.
Okay.
Or they depend on things that might not happen in the future.
Got it.
They might sound exciting,
Yeah.
but they're risky.
Especially for passive investors.
Right, who are relying on the sponsor's expertise.
So it's about sticking with properties that have wider appeal, more stable demand,
right.
less risk.
Yeah.
Let's say we've found a property that looks good.
Okay.
Checks all the boxes.
Mm-hmm.
What's next?
Due diligence.
Okay.
That's crucial.
Right. We're not just taking things at face value.
Exactly. You need to thoroughly assess the property and the sponsor.
So what does due diligence actually involve?
Well, it starts with a structural and technical assessment.
Okay.
You bring in qualified building consultants.
Got it.
To inspect the property,
Mm-hmm.
looking for any potential issues.
So it's like a health checkup.
Yeah. Good way to think about it.
Making sure there are no hidden problems that could cost a lot to fix.
Yeah,
What else is part of this?
It goes beyond the building itself.
Okay.
Our research says you need legal and accounting reviews.
Got it.
You need lawyers and accountants
Mm-hmm.
to look over the contracts,
Yeah.
financial statements,
Okay.
all the important documents
Got it.
to make sure everything is in order.
So it's about dotting the I's and crossing the T's, making sure the investment is sound and transparent.
Right.
Okay, so due diligence is done.
Yeah.
Everything checks out.
Mm-hmm.
It's time to invest.
Right.
How does that work with a property syndicate?
Typically, it's a staged process.
Okay.
Usually, you start with around 30% of your total investment up front.
Got it.
That money goes into a secure account,
Okay.
ready for the initial deposit on the property.
So it's a collective commitment.
Exactly.
Showing everyone's serious.
Right.
What about the other 70%?
That's usually due within 28 days of signing the purchase contract.
Okay, so it's a pretty quick turnaround.
It is.
But that's a big chunk of change.
Yeah.
Do investors have to pay for all of that out of pocket?
That's interesting.
Okay.
Our research mentioned that some syndicates work with lenders who offer personal loans to investors.
Okay.
So they can use the tax benefits of property investing
Yeah.
to potentially boost their returns and optimize their finances.
That's a smart move.
It is.
Now, the big question,
Yeah.
what kind of returns can investors expect from a property syndicate?
That's the million-dollar question.
What does the research say?
It suggests aiming for a yield of 7% to 9%.
Okay.
But that can change depending on a lot of things.
All right, let's break that down.
Okay.
What are the key things that can affect the yield?
Well, you've got the obvious ones.
Like what?
Type of property,
Mm-hmm.
location condition.
Okay, got it.
A prime commercial property downtown will probably have a higher yield
Right.
than a residential property in a less desirable area.
Makes sense.
But there are less obvious factors too.
Okay.
The lease structure
Mhm.
and how stable the tenants are.
Got it.
Those are important too.
In what way?
A property with long-term leases from reliable tenants is usually more attractive,
Okay.
leading to higher and more predictable yields.
So it's about minimizing the risk
Exactly.
and maximizing that steady rental income.
Right.
What's a good yield range for these?
Well, our research seems to think that a sweet spot for syndicates is between 7.5% and 8.5%.
Okay.
They believe this range is a good foundation for a successful long-term strategy.
7.5% to 8.5%, the golden range for property syndicate yields.
You could say that.
But before we get too excited about the potential returns,
Yeah.
We need to talk about the risks.
Right. No investment is without risk.
That's true.
And it's important to understand both the potential rewards and the potential downsides.
Okay.
Our research is very clear about this.
Yeah.
Property syndication has a lot of opportunity, but it's not without risks.
All right, so let's talk about the risks.
Okay.
What are some of the things investors should watch out for?
Well, the biggest one is that the property might not perform as expected.
Oh, okay.
The market can change.
Right.
Tenants can leave.
Yeah.
Unexpected repairs might come up.
Got it.
All these things can affect how profitable the investment is.
So no guarantees.
Exactly.
Investors need to be prepared for things to not go as planned.
Right.
What other risks are there?
There's also the risk of the sponsor themselves.
Okay.
Most sponsors are good and honest.
Right.
But there's always the chance you could run into a bad one.
Oh, no.
Someone who might mismanage the money or do unethical things.
That's scary.
It is.
How can investors protect themselves from that?
Due diligence. Due diligence.
Checking their track record.
Jack.
Experience, reputation.
It's all important.
So it's about asking the tough questions.
Right.
Looking into their past projects.
Yeah.
Making sure they have a history of success and doing things the right way.
Exactly.
Due diligence isn't just about the property.
Right.
It's about the people behind it, too.
Absolutely.
We've covered a lot today.
We have.
What do we do now?
Let's take a break here.
Okay.
And come back for part 2 of our deep dive.
Sounds good. I'm looking forward to it.
Welcome back. I'm ready to get back into these property syndicates.
Yeah.
We were just talking about the risks, and it's really hit home how important due diligence is. It's crucial. It's your protection against problems.
Yeah, right.
Imagine buying an old car without checking its history.
Yeah.
You wouldn't do that, would you?
No.
You'd want to know if it had been in accidents.
Right.
How well it's been taken care of.
Right.
Any hidden issues.
It's a big investment.
Right.
You don't want to end up with a lemon.
Exactly. Same thing with property syndicates.
Okay.
You have to investigate the sponsor, their finances, the project itself.
Got it.
It's all about reducing risk.
Right.
By getting as much info as you can before you jump in.
So due diligence is like our detective work.
Yeah, good way to put it.
Uncovering any red flags.
Right.
Or problems that might be hiding.
Don't be afraid to ask those tough questions.
Okay.
Verify everything.
Yeah.
And if something feels off, walk away.
Good advice.
It's your money.
Right.
You deserve to feel confident in your investments.
I like that analogy of the detective.
Yeah.
It really shows how important it is to be thorough and a bit skeptical. But we've covered so much already.
We have.
How these syndicates work.
Yeah.
The pros, the cons.
Right.
The legal and financial details.
It's a lot to take in.
It is. What does it all mean for someone new to real estate investing?
That's the question, isn't it?
It is.
How can we actually use this knowledge? What's so cool about property syndication is it's a different way to invest in real estate.
Okay.
It can be really rewarding, but it needs careful thought.
Right.
It's not a quick way to get rich.
No.
It's a strategy that needs to fit with your goals.
So let's break it down.
Okay.
If someone is thinking about trying this out, what are the main things to keep in mind?
First, make sure your investment fits with your overall real estate plan.
Got it.
What are your long-term goals?
Right.
Passive income, capital appreciation.
Okay.
Both.
Got it.
Syndication can be adjusted for different goals.
Okay.
But you have to pick a project that matches what you want.
Yeah. So it's not a one-size-fits-all approach.
Right. You need to know what you want and then find a syndicate that fits.
And once you've found a potential opportunity.
Due diligence.
Yeah.
It's your best friend.
Okay.
Read those offering documents carefully. Do your research on the sponsor.
Yeah.
Don't be shy about asking questions.
Good advice.
Knowledge is power when it comes to investing.
It really is.
And the best decisions come from being informed.
So due diligence is a must.
It is.
What else should investors think about?
Your risk tolerance.
Okay.
Every investment has some risk. Syndication is no different.
Right.
You need to be honest with yourself.
Yeah.
About how comfortable you are with market changes.
Okay.
Unexpected costs.
Yeah.
Even the possibility of losing some of your money.
It's about being realistic.
It is.
Making sure the risk level is right for you.
Right. No one wants to stress over their investments.
Exactly.
Now, if you've done your research, you've done your due diligence, and you think syndication is a good fit.
Okay.
Remember, diversification is still key.
Right, not putting all our eggs in one basket.
Exactly. Spread your investments.
Okay.
Maybe different syndicates, different property types.
Got it.
Different locations.
So it's like a safety net.
Yeah, good way to think about it.
Reducing the impact if one property doesn't do well.
Right. Diversification is essential for smart investing.
It is.
And that includes property syndication.
Now, remember that research we talked about?
Yeah.
About the key factors for a successful syndicate model?
Mm-hmm.
Structuring it as a unit trust for liability protection?
Yeah. And the tax benefits.
Right, and keeping the borrowing under 65%.
Mm-hmm.
And those regular reviews every 4 years.
Exactly. Those are really valuable insights.
They are.
From people with experience.
It's like having a roadmap.
Yeah, a good analogy.
Showing us the way and the potential bumps in the road.
But remember, it's just a starting point.
Okay.
Syndication is always changing.
Right.
You need to keep learning.
Got it.
Stay updated on the market.
Mm-hmm.
Connect with other investors.
Yeah.
Never stop learning.
It's a journey, not a destination.
Well said.
And speaking of journeys,
Yeah.
our deep dive isn't over yet.
That's right.
We'll be back for part 3, where we'll explore.
Oh, this is exciting.
Let's just say it's a surprise.
A surprise. Okay, I can't wait.
See you in part 3. Welcome back, everyone. For this final part of our deep dive, I think it's time to unearth those last few nuggets of wisdom from our research stash.
Sounds good. I'm ready.
We were just touching upon those crucial factors for a successful syndicate model.
Right. The ones about the unit trust structure.
Exactly. Keeping those borrowings in check under 65%. And of course, those regular reviews every 4 years or so.
Right. Those guidelines really highlight the importance of strategic thinking when creating a syndicate that's meant to last.
They do. And speaking of strategy, let's go back to those purchase criteria we talked about earlier. Those guidelines for choosing the right property.
Yeah. It was like a checklist for finding the gems and avoiding the duds.
Absolutely. It was packed with insights. So remind me, what were some of those key things investors should look for in a property?
Well, adaptability was huge.
Yeah.
We talked about finding a property that works for different uses.
Right, like a building that could switch from offices to retail or even apartments.
Exactly. It's about being flexible.
A real estate chameleon, ready for anything.
Right. And then there's making sure it follows all the legal and planning rules.
Yeah. You don't want any legal surprises down the line.
Nope. And of course, we can't forget about newer properties with those nice depreciation allowances.
Yes, those tax advantages.
They can make a big difference to your return on investment.
Speaking of making a difference, what about those ongoing costs?
Yeah, those can really eat into your profits.
Exactly. Turning a potential cash cow into a money pit.
Right. So low maintenance was a big one.
Makes sense. Finding a property that's built to last and doesn't need constant repairs.
It's like finding a car that's reliable and doesn't spend all its time in the shop.
Exactly. You want an investment that works without you having to babysit it.
And we talked about design, too.
Right. Not just any design, though.
Timeless or adaptable designs.
Right. Properties that can change with the market.
Exactly. Like open floor plans that can be reconfigured or properties that can be split into smaller units.
It's about making sure your investment is ready for the future.
Future-proofing it. Exactly.
And of course, we can't forget about location.
Right. The golden rule of real estate.
It's all about location, location, location.
Our research backs that up.
Okay.
They recommend properties in thriving cities.
Right.
Preferably not too far from the CBD.
So being in the heart of the action.
Yeah, where the economy is strong and people want to be.
But just as there are good properties, there are some that are a definite no-no.
Absolutely.
What were those again?
Those speculative or specialized properties?
Right.
They're too risky, especially for passive investors.
So stick with properties that have broader appeal.
Exactly.
Are more established and have less risk. But even with the perfect property, due diligence is still crucial.
It always is. It's about being thorough.
Asking the right questions.
Checking everything is in order.
Making sure you're making a wise investment.
It's like laying the foundation for a house.
Right. Without a strong foundation, the whole thing falls apart.
Exactly.
Well, we've covered a lot in this deep dive.
We have.
We've looked at property syndication from all angles.
It's been a thorough exploration.
As we wrap things up, what are your final thoughts for our listeners?
Property syndication is a unique way to invest in real estate.
It is.
It has great potential. But like any investment, you need to be careful, do your research, and understand the risks.
Okay.
It's not a passive get-rich-quick scheme.
No.
You have to be an active and informed investor.
Great advice. So to our listeners, remember the key takeaways.
Yes.
Figure out your goals. Make sure they align with your overall real estate plans.
Right.
And most importantly, do your due diligence.
Couldn't agree more.
And never stop learning.
Exactly.
The real estate world is always changing. Stay curious, stay informed, and keep exploring.
That's the key.
And on that note, we'll wrap up our deep dive into property syndicates.
It's been a pleasure.
Until next time, happy investing, everyone.